Okay, welcome to Economics 232. This is Dr. James Young, Gadsden State, and here we're going to be reviewing production costs in Chapter 7. Just a quick reminder, this is just a video lecture. This is not a quiz. There are no quiz questions. I'm going to try and keep these short and sweet, and because I realize the longer they are, the fewer people who watch them. So we will get started real quick. We're going to be using the Applia assignment, which for Chapter 7 to help us with this. So we're going to work some problems while we're doing this. Okay, Chapter 7 is titled Production Costs. When we talk about a firm in mainstream economics, economics has a hard time describing what goes on inside the firm. The way they do that is through these cost curves, and we're going to use these cost curves to study the relationship between production and costs. And these cost curves are going to represent the firm, and we're going to use them to explain or predict how a firm makes decisions, how much output they produce. So if we're producing, say, 10 tires at the Goodyear plant, the number of tires that they decide how to produce is going to be determined by these cost curves where marginal revenue equals marginal cost because they're profit maximizers. That would determine how much output they'll produce. We trace that output up to the demand curve, and that will tell us what price they will charge on the market, what all those tires will sell at. We can use this to determine whether or not the firm is making a profit. We can take price times quantity, price times the number of tires they sell. That would be our total revenue. We could subtract out the total cost, which would be the average total cost at that unit of output times the number of units of output. So we're going to use this to determine whether or not firms are making a profit or a loss or breaking even, how much output they'll produce, and what price they'll charge for that output. So that's what we're doing here. One basic assumption in mainstream economics is that all firms are profit maximizers, that every single decision a firm makes is based on how it will affect total profit, and they will make a set of decisions that produces the maximum profit possible for that firm. Now you've got to remember that's an assumption, and when you assume, we know what happens. Okay? You know what out of you and me. Okay? So here, many socialists and left-wingers say, oh, businesses are so cold and horrible, and all they do is think about profits, and they don't think about human beings, because they took one economics course that said all firms are profit maximizers, that we assume that so we can predict their behavior. That does not make it true. There's no proof behind it. In fact, the proof would be on the opposite side, right? You'll have employers who will make decisions that don't maximize profits, good and bad. Okay, nepotism is one perfect example of this, right? You hire your wife's cousin because your mother-in-law asked you to, and he's not a good worker, and you could have done better, but you keep him on to keep your mother-in-law happy. That's not maximizing profits. Businesses donate money all the time to causes where they probably aren't going to generate any real goodwill towards the company that would result in enough sales to make that donation worthwhile. So don't think that that's a true thing. It's just an assumption the mainstream makes so they can predict the behavior of firms. Okay. So when we talk about profit, we have to distinguish between the way that accountants can't measure cost and the way that economists measure cost. They're different. Okay? You've got to remember, an accountant counts things. Accountants only count explicit costs. These are payments, you should write this down in your notes, payments to non-owners of a firm for their resources. Simple example, I work for Gadsden State. My labor is mine, not Gadsden State's. I own my labor. Therefore, if they want my labor, they have to pay me for it. My paycheck, salaries are explicit cost. If you pay the electric bill, that's an explicit cost. There's a receipt or a bill and an exchange of money that the accountants can count, and we call those explicit costs. The other type of cost, these are costs that accountants don't count, but economists do, are implicit costs. And these are the opportunity cost of using resources owned by the firm. Let's say Goodyear has an 18-wheel tractor-trailer truck that they use to deliver their tires, that they own. Okay? They could, instead of using that truck to deliver their tires, rent it out. The opportunity cost of that truck would be the money that they could bring into the firm by renting the truck out to someone else, but instead they use the truck in the firm. They're not a truck rental business, they're a tire making business. So the implicit cost here would be the value or the rent that they could have gotten if they had rented the truck out to someone else. Many entrepreneurs provide their own labor to the firm, okay, unless they write themselves a paycheck for that labor, okay. Their entrepreneurial skills used somewhere else, or their labor used somewhere else, would be the opportunity cost. So I could run this business, or I could work for another company and make $100,000 a year. In that case, the implicit cost to the business of the entrepreneur's labor, of my labor, would be the $100,000 that I could make as the owner working for someone else. And here's another little bit of information on it. When a firm uses its own resources, such as the owner's labor, land, building, or savings, and that would be the interest we could earn on those savings, a firm gives up the opportunity cost of earning a return on its resources. So my savings that I leave in the business, I could put in a savings account and make 0.05% interest. That 0.05% interest would be the opportunity cost of leaving my savings within the firm. Okay. Now, an economist looks at what we call total opportunity cost when he calculates profit. Profit is total revenue minus the total opportunity cost for an economist. And an economist includes both what the accountant looks at, those explicit costs, and he does something the accountant doesn't do. He adds in these implicit costs. So now we're going to go to the Apply assignment and use. So here we go. Oops, I got the wrong one. Let me go back. We're going to start with the first assignment. Here's the Apply. This is homework, chapter 07. Chapter 7, this is the Apply assignment. Okay, here's cost and profit. Here, we'll start here. Now here, Lorenzo lives in Philadelphia and runs a business that sells guitars. In an average year, he pays $701,000 from. He receives $701,000 from selling guitars. Of this sales revenue, he must pay the manufacturer a wholesale cost of $420,000. So if you're in accounting, that would be your cost of goods sold. He also pays wages and utility bills totaling $247,000. So there's a receipt or a bill here, okay, or a check to count. So that would be an accounting cost that he has to pay. He owns his showroom. If he chooses to rent it out, he will receive $9,000 in rent per year. So if he rented out the showroom, he could be bringing in $9,000 in rent per year. That $9,000 in rent is the opportunity cost of using the showroom to sell guitars for his business, and the opportunity cost of that is the $9,000 he could make in rent per year. So that $9,000 in rent per year he could earn is an implicit cost. An accountant isn't going to count that. Assume the value of the showroom does not depreciate over the year. Also, if Lorenzo does not operate this guitar business, he can work as a financial advisor and receive an annual salary of $32,000 with no additional monetary costs. No other costs are incurred in running the guitar business. So again, here he's using his labor inside the business If he were to go out on the market, he could make $32,000 a year in wages with that labor. That is an opportunity cost of him running this business. So that is going to be an implicit cost. So the wages and utility bills that Lorenzo pays, if you get confused, remember, we can count explicit cost. Accountants count. There's a bill or a paycheck, something that they can count here, so that's an explicit cost. The wholesale cost for the guitars that Lorenzo pays the manufacturer. Again, he writes a check, there's a bill, that's an explicit cost. We can count that. An accountant can count that. The salary Lorenzo could earn if he worked as a financial advisor. The accountant does not count that. There's no receipt, no bill. That's just if he didn't run the business, he could make that salary working for another company as a financial advisor. So that's an implicit cost. Only economists count implicit costs. Accountants only count things with checks and bills and receipts. There is no check, bill, or receipt for the opportunity cost of his labor. That's an implicit cost. The rental income Lorenzo could receive if he chose to rent out his showroom. Again, there's no bill, there's nothing to count. That's an opportunity cost of using the showroom in his business. That's an implicit cost. Now, if we wanted to calculate the accounting cost here, I'm going to get my calculator out. Here we go. Okay. Here, he brings in total revenue of $701,000. I'm going to clear this out here. So that's his revenue. $701,000 is how much he brings in from selling the guitars. He has explicit costs of $420,000. The cost of goods sold, how much he pays to buy those guitars wholesale. He also pays wages and utility bills. So we'll hit minus. He also pays, that's money coming out of his pocket, so that's a negative, $247,000 in wages and other bills. He has no other explicit costs, so we're going to hit equals here. And that is his accounting profit. He makes an accounting profit of $34,000. So an accountant says, oh, good job. You made an accounting profit. An economist is going to come in and say, whoa, hold on here. Sure, you've got that $34,000 accounting profit, but look at what else you're losing. If you didn't run this business, okay, you would have to pay, you would be paid $9,000 in rent for the building. So we're going to do this again. Here's an economist looking at it. There's the $701,000 in revenue you made from selling the guitars. We're going to subtract out the explicit costs, that's these two here. The $420,000 you got to write a check for every year to pay for the guitars. The $247,000 checks you have to write to pay wages and your utility bills. So there's your $34,000 accounting profit, but there's other things you have to consider if you're running the business. You could have been receiving $9,000. So we're going to subtract out $9,000. You could have been earning $9,000 if you rented out the building, and you could have made $32,000 if you worked for someone else. So when we look here, we're going to get a negative $7,000 in accounting profit. He would be better off, assuming that he didn't like running his own business more than any other, and there's other things to consider here, but he would be better off selling this business, just selling it off, okay, or shutting it down, renting out the building and working for someone else, he makes $41,000. But by running the business, he only brings in $34,000 in this accounting profit, but he gives up that $41,000 that he could have made by working for someone else and renting out the business. So he's got $41,000 that he could have made by working and renting out the business. By using those resources, his labor and the showroom in his business, he only makes $34,000. He suffers a $7,000 economic loss, and that's why I've got a negative sign here. Okay. Alternatively, the economic profit he would earn as an advisor would be that $7,000. Okay. Because he would rent the building out. If Lorenzo's goal is to maximize his economic profit, he should not stay in the guitar business, get out of the business, shut it down, rent the building out, and go work as a financial advisor for $32,000. Now, a normal economic profit, and you can go back to the PowerPoint slides to see this, okay? A normal economic profit, if you take total revenue minus explicit, those are the ones the accountants count, and implicit costs, if you subtract both of these from total revenue, that's your economic profit. Our economic profit was a negative $7,000. A normal economic profit, which is the minimum profit necessary to keep a firm in operation, okay, is the case where total revenue equals its total opportunity cost. Okay. So in this case, our guy, I forgot his name, Lorenzo, would be better off shutting down the business. A normal economic profit is exactly zero. That's where total revenue minus implicit and explicit cost is exactly equal to zero. If that were the case, if this number here were zero, Lorenzo wouldn't be any better or worse off financially by shutting the business down. He'd still make the same amount of money. So that would be just enough profit to keep the business in operation. That's what a normal economic profit is. It's the level of profit necessary to just keep the business in operation. And that normal profit is a zero economic profit. Okay? Thank you very much. Have a great day. Enjoy the lecture, or in the quizzes later.